Good morning, everybody. How are you doing this morning? All good? Monday morning? Good. Well, a big warm welcome to everybody to ODI on behalf of BII, the Grantham Research Institute of LSE and ODI. We're really thrilled to host the launch of this climate report today. The report's now in its third year, and it explores how the climate emergency is affecting companies in emerging economies, how they're responding, but also how investors like BII can better support them in this challenge. So we have a great agenda lined up today with an esteemed panel to discuss the report, but also broader issues associated with the climate emergency. So we should hear some really interesting perspectives and have a debate afterwards. And there's no doubt that climate change is impacting business in emerging economies and that this impact is intensifying. And to hear more about this, I'd like to welcome Nicola Mustiti, hopefully I pronounced that correctly, Director and Head of Climate at BII, who's going to present the report for about 15 minutes. And then we're going to dive into a great panel discussion chaired by Amal Lee Amin, who is an MD and Director or Head of Climate Diversity and Advisory at BII, which will be followed by some questions and answers. And then we are going to have a wrap up and then go for lunch, which is going to be hosted outside. A couple of points before I hand over. If you hear the fire alarm, it's real, but don't panic. There is a fire exit, just literally come out this door here on the left and we go out there and we walk all the way around to under the bridge, or people on that side of the room, perhaps you go right out the main door and we meet under the bridge. And also the toilets are also in the reception area. So without further ado, let's get started. Nicola, please.
Thank you very much, Sam, and thanks ODI for hosting us, which I think will hopefully be a very exciting session. So at BII, supporting countries and economies in their just transition to net zero and climate resilient economies is actually a core part of our investment strategy. And clearly, I think we all know that the climate change, climate emergency has never been, so obvious and also so severe. So we really want to step up as a trusted partner to companies that offer solutions towards the climate emergency, but also to all businesses to really provide them patient capital to make the transition and become equipped to really take advantages of the opportunities that the transition offers as well. So why are we here today? We're here today because we're launching our report, the Emerging Economies Climate Survey Report, because for us as an investor, we really need to know what our portfolio is actually thinking in terms of how they experience climate change. And we, for the first time, I think, as Sam said, conducted a survey in 2021 and have repeated this now for the third time. So we also see some kind of trends in terms of the results now as well. So as Sam mentioned, the report covers three themes that I will talk you through. The first is how the climate emergency is affecting businesses already. The second part is about how businesses are responding to that challenge. And the third area is around how investors can better support businesses as we move to a greener future. So why is this important to BII? For us, climate change is more than just a investment strategy. This is really about the real experiences of the companies that we invest in, the workers they employ, and then also the communities that these businesses serve with their products and services. So hopefully this survey really builds our common understanding how we can better work together to help businesses become better equipped to address the climate challenge. So before I dive into the specifics of the results of the report, I just want to give you a brief overview of how we conducted the survey. We had over 100 respondents from senior executives working across our portfolio of companies and funds in Africa, Asia, and the Caribbean. These businesses were split between corporates, financial institutions, and fund managers, so each bringing different perspectives to the table. You might be aware that at BII, we invest across multiple sectors, spanning from infrastructure, agriculture, technology and telecoms, financial services, and much more. And the survey responses reflect that sort of diversity of sectoral experience. In addition to the online survey, we also conducted 6 interviews to explore at a more personal level the sentiment of the respondents and get to some of the more real-life stories as well in terms of how climate change is affecting their business. So I'll start with the first part in terms of the question how climate change is already affecting businesses and emerging economies. So it's very clear from our survey results, which isn't a surprise, that climate change is already being felt financially, socially, and environmentally across our portfolio. Of our respondents, 79% said that climate change is impacting them already today, which is quite a significant 10 percentage point rise since 2022. If you look at the more sort of geographical split. Sorry, I should go back to the last slide. Respondents in Africa felt slightly more impacted by climate change risks than their counterparts in Asia, as shown in this figure, and we dive into some of the more geographical consideration a bit later as well. In the survey, we asked them about the 2 types of climate-related financial risks, so that's physical risks and transition risks. So what you can see on these charts is that concerns about both types of risks has actually increased compared to the results in the previous year. So if we start on the right-hand side of this slide, on physical risks, a total of 87% of respondents agreed that they are actually concerned about physical risks, which is a significant increase compared to the 70% in the previous year. On the transition risk side, 73% of respondents agreed that they were concerned about the risks associated with the low carbon transition, which again is quite a substantial increase from 66% in the previous year. I mean, none of this should be too surprising. I mean, I think we've all either experienced or heard about the increase in climate-related weather events in these markets in particular. And this coupled with the economic uncertainties and the potential shift to lower carbon economies due to market and regulatory conditions all explains, I think, this increase in sentiment. So diving a bit more into detail in terms of how our respondents in the businesses that we invest in have experienced extreme weather events. So 59% of them agreed that they already seen the impact of climate change on their business, which is quite a similar result to the previous year. And again, if I bring a bit the experience of some of our investees to this, a respondent actually in one of our agricultural companies said that they've already experienced unprecedented flooding, drought, and extreme temperature, and therefore their focus is really for immediate adaptation to actually ensure the survival of their business. In an interview, said that it was incomprehensible that these risks could worsen and painted a picture of great vulnerability in the face of climate impact. So it's really coming to the core of business survival for some of our respondents already. If we look at the different types of physical risks that our portfolio companies are facing, flooding and drought continue to be the physical risks impacting them the most. When we compare this to the previous year, this trend remains consistent with the same top 3 physical climate risks identified in the following order of priority. So that's flooding, drought, and extreme heat. So again, if we also looked into different time horizons in terms of how we pose the questions to the survey participants. So we asked them to look ahead in terms of the 5-year future and then the 10-year future as well. So looking ahead, they identified the same 3 top physical risks that I just mentioned in terms of them still being the top risks in the future as well. But there was a slight shift in the order of these risks compared to the present perception with extreme temperatures and drought emerging as the primary concerns. So when we look at Africa and Asia-specific experiences with this, businesses in Africa identified drought as the top physical risk at present, and that pattern remained consistent also with a 5-year outlook as well. But when businesses in Africa looked ahead in terms of a 10-year outlook, both drought and extreme temperature actually emerged as the top joint risk. When we look at Asia, respondents listed flooding as the top physical risks currently. Again, this reflects obviously the reality that a lot of businesses and communities faced in these markets in terms of the record-breaking levels of glacier melt that exacerbated the 2022 monsoon season and increased flood damage. In Asia, firms also identified extreme temperature as a key physical risk, and again, this also reflects that in 2023, Southeast Asia experienced a once in a 200-year heat wave. I'm trying to move to the next slide. The report then looked into how these physical risks that I just outlined affected businesses in terms of their sort of operations and also from an investor perspective, their investments as well. So operations and investments are those parts of the value chain that are most frequently disrupted by extreme weather events. And within operations and investments, the top physical risk was flooding. And when we looked at the workforce, respondents indicated that flooding, drought, and heat were the top physical risks that were affecting basically their workforce already over the last 5 years. When we look at the supply chain, only around 13% of respondents reported supply chain disruptions due to climate change. I mean, this is a relatively low percentage, but probably also is influenced by the challenges of actually, obtaining comprehensive data on climate-related financial impacts in the supply chain. Because again, due to some of the interviews that we conducted in addition to the survey itself, one respondent, for example, described how flooding had affected their feedstock supply, resulting in reduced operational performance of one of their plants. So again, the low number might be more due to sort of data issues of collecting it, but some respondents are definitely feeling the supply chain disruptions already. When we come to transition risks, market shifts were the risks that are impacting firms most today, and that trend remained constant over the next 5 years. So when we talk about market shifts, we talk about changes in energy prices, we talk about the ongoing transition to renewable energy as well. When we look 10 years ahead, policy-related factors such as carbon prices emerged as the top transition risks, and market shifts became a close second. On the consumer side, consumer shifts in terms of demand for certain products and service was the third ranked transition risks actually across all 3 time horizons. So I think as we can see, this really indicates a sustained focus by businesses on market dynamics, policy developments, as well as evolving consumer behavior. We then asked survey participants whether they think climate change will actually affect the viability and growth of their business. And here we see an increase over the time horizons. So if you ask this question over a 5-year time horizon, 61% of respondents agreed with that sort of statement that climate change will impact their business growth and viability, and it will increase to 76% when looking ahead over the next 10 years as well. So becoming a really core sort of business concern. So the second part of the survey was about how businesses are already responding or planning to respond to the risks that they are feeling already. Nearly all respondents agreed that long-term success is linked to lowering greenhouse gas emissions and reducing vulnerability to physical risk. So you see here quite a high number of 97% of respondents who agreed with that statement, which is a steady increase compared to the previous year. So that number was 91% in 2022 and 82% in 2021. So you can really see that sort of growing belief in our portfolio in terms of, really addressing climate change has to become an absolute core part of long-term business strategy as well. But then the question clearly is how this sort of belief actually translates into business action. So we looked into this both in terms of business strategy and financial planning, and asked respondents to what extent they've already included climate change both on the business strategy side and into their financial planning. So 65% have already adapted their strategy, and 47% have adapted their financial planning in response to climate change. So there's obviously a slight gap in those numbers. I mean, I think it's potentially likely that businesses first start with a sort of broader strategic approach to climate change in their business strategy before they move on to integrating it actually into their financial planning. And we all know there's still some data issues as well, I think, that we're all facing in terms of how to do this and in terms of the integration of climate change into financial metrics. So these numbers probably reflect that sort of broader challenge. There was a slight decrease in the numbers who actually adapted their strategy compared with the previous year, but the number of respondents who are planning to adapt their strategy has increased quite significantly. So 17% have now plans to adapt their strategy compared to 2% in the previous year of the survey. So many respondents highlighted as well that acting on climate change can be cost saving and add to long-term business value, including in relation to raising capital from investors as well. So there's a variety of ways to respond to climate change in business strategy and financial planning. And as you can see, I think from this chart, all of which are deployed to some extent by our portfolio companies. The most common approach that has been cited is, which is particularly relevant probably more for fund managers, is to exclude investments in products and services that are considered to have a negative impact on the planet. And then on a more positive side, again, potentially particularly relevant for fund managers, more fund managers are raising funds targeting climate solutions. And one of the interviewees actually commented that, already investing in renewables and preparing for the transition will enable the best companies to get an advantage over time. There were some other measures as well that people are deploying. So that includes increased stakeholder engagement on climate issues, also in relation to meeting the expectations of investors and consumers, as well as on supply chain management as well. Coming to the financial planning side, so here the top themes were operational costs, capital expenditure, and access to capital as the top themes in terms of how climate change has impacted those. 48% of those who responded that climate change was affecting their financial planning said climate change is already increasing the operational expenditures, which is quite a significant increase from the 30% in the previous year. And again, one of the interviewees actually commented that they are planning to allocate more resources to increase efficiency and reduce costs from high to low carbon energy. In particular, they are doing this to increase their competitiveness compared to other companies in the same sector. In relation to access to capital, 46% have said that climate change has affected their access to capital, and this mainly relates to increased investor expectations on climate change, because investors are also, experiencing the change in regulatory and market conditions that are then filtering down in terms of the companies that they invest and the expectations that they have. On the capital expenditure side, quite a significant number of firms are already investing in climate resilience because 46% said that climate change had already affected their capital expenditure and allocation decisions. So coming on to the third part, which is very much around what businesses need to effectively tackle climate change. So clearly businesses in emerging economies in particular are confronted by a host of additional pressures associated with the impact of climate change, to which many of those countries have contributed very little to. And this means that, companies in emerging economies in particular need more support to really address climate change as well. So our research in this area uncovered 4 areas where businesses in particular expressed an interest for greater support. And that includes capacity building, targeted technical assistance, targeted funding and investment, as well as regulatory conditions. So starting on the capacity building side. The survey responses and also the follow-up interviews unearthed a wide range of capacity building requests, mostly around peer knowledge sharing and practical sector-specific training. So respondents really asked for more peer-to-peer learning opportunities, webinars, networking with external experts to strengthen their best practice and improve their access to climate solutions and tools. They also expressed an interest for practical tailored training as well. And those in particular who were already exposed to physical risks also demanded that a lot of these trainings should focus more on short-term adaptation methods that can be implemented immediately as well for them to deal with these physical risks. There was also a notion that capacity building should be more sector specific and should be more based on actually real life case studies and should be really grounded in an understanding of the conditions of these businesses who are operating in these countries as well. And then the last point, I think that was quite relevant to the capacity building point, again, was that capacity building really needs to take into account that these businesses are having competing objectives and therefore providing more practical advice how climate change can be addressed in a sort of way that aligns with their sort of broader business strategy was a sort of key theme. In addition to capacity building, targeted advisory support has also a really important role to play. And across all respondents, there were 4 areas most commonly requiring targeted technical assistance. So those included strategy development, greenhouse gas accounting, adaptation planning, and reporting against disclosure frameworks such as TCFD and now IFRS 2. This finding was also backed up by our interviews. So we had some interviews from Kinara Capital and Inspired Evolution who emphasized a particular need for external assistance on greenhouse gas accounting, particularly around scope 3 carbon footprinting. So targeted support, I think, again, can really help firms how to integrate climate change in a way that aligns with their sort of broader business objectives. On the investment side, again, this is not a surprising result, but 98% of respondents think that actually better investment is needed to help the transition, which is a slight increase from the 92% in the previous year. So respondents here commonly refer to capital expenditure support, funding instruments, and improved climate finance, again, which should be deployed in combination with other mechanisms such as targeted technical assistance for a really sort of rounded approach as well. Particularly corporates requested support with capital expenditure to implement climate mitigation projects, particularly in countries where maybe the sort of regulatory environment is still hindering sort of the deployment at scale at this point in time. That also underlines the importance of the policy and regulatory environment, and respondents very much highlighted the need for top-down policy signals and policy levers to incentivize climate action among businesses. They felt that this would foster an environment for climate innovation and entrepreneurship by really encouraging transparency and more ambitious target setting. Here again, the respondents also highlighted the need to really think about the different sort of economic, social, and environmental conditions in the countries in Africa, Asia, and the Caribbean, and therefore really the importance of avoiding a one-size-fits-all approach in terms of the investment approaches, but also the targeted technical support as well. So just concluding briefly in terms of how we look at this from a BII perspective as well. So from a BII perspective, as a development finance institution, we both have financial support and sort of what we would call value add services that we can offer to businesses. So on climate in particular, at BII, we have a 30% climate finance targets of our commitments, where we're really focusing on supporting companies that are offering climate solutions. And over the last 2 years, we deployed over $1 billion of climate finance into those markets. But I think what I wanted to also stress that this is really beyond what we would call climate finance and the 30% that we have, because we also have a commitment, what we would call Paris alignment of our portfolio and of our transactions, and therefore we assess climate risks and opportunities across our transactions. So not only the 30%, which is very targeted at finding these sorts of climate solutions. So that means in practice, we can provide finance to companies that might not be focused on offering climate solutions today in order for them to implement decarbonization and adaptation measures as well. And we can really complement our sort of investment offering by a range of other tools as well on the non-financial side. So we can provide advisory from our in-house teams. We also have a dedicated technical assistance program as well, which is really tailored to support portfolio companies on greenhouse gas assessments, helping them to develop transition plans, but then also helping them to identify physical risks and developing adaptation respondents. In addition to that, we are also increasingly making tools available for free on our website to the broader market. So that includes sector-specific guidance. It includes guidance on TCFD implementation, and going forward also on net zero target setting and sort of climate opportunity origination as well. So there's much more to come in that space. So I'm coming to the end. So I leave you with that sort of conclusion here. So again, we've seen that climate change has impacted more and more firms in the economies that we invest in 2023 compared to the already quite high level that we've seen in previous year. And it's quite crucial that 97% of respondents really see climate change as critical to their long-term business success. And what we've also seen in the report is that more and more companies are actually developing the skills and capacity to deal with these climate-related risks and take advantage of these opportunities. But I think what's also become clear that they need more support from all kinds of different investors, both on the investment side and the technical assistance side, to further integrate this into their financial planning in particular. So hopefully, I think this underlines that there's a real great opportunity for different investors, different businesses to really work together on a lot of these issues, which I think we're actually exploring in the panel now as well. So I will hand over to Amalie to introduce the panel.
So delighted to introduce the panel. We actually have two of our investees joining online, so hopefully we'll be able to see them up on the screen. Maybe whilst we do that, I'll invite the two in-person panelists. So Michael Jacobs, who is probably familiar to many of you here, senior visiting fellow here at ODI, professor of political economy at Sheffield University, and many years working in different contexts around the international climate and climate finance architecture, including in the build-up to Paris as Gordon Brown's special advisor. So, and Nick Robbins, who is probably also familiar to many of you here, and certainly many of you online, who is now at LSE Grantham School as one of the co-sponsors of this event, and recently launched very exciting new initiative, Just Transition Finance Lab. Has worked in many different contexts around sustainable finance. You're a professor of sustainable finance at LSE. I think I first met you when you were at Henderson, then you moved on to HSBC to head up their Sustainable Finance Centre, and then the UNEP inquiry on sustainable finance, which I recall very well as well. So great, and now I see we have Benjamin Njenga from Agriculture Apollo. Good to see you, Benjamin. Ben, I will refer to you. We're going to hear more from you in a second about Apollo Agriculture, really innovative investment that investee that we've made an investment in, providing services to smallholder farmers, particularly in light of some of these risks that are being faced as a result of climate change. And then delighted to see Shivendra Nambaga. Sorry, you were zooming in and out, but I think we've got you now. Shiv, as I think is known to many of us, who heads up Ayana Renewables, one of, if not the biggest, renewable energy investor, developer and investor in India. We have been partnering with Ayana since the beginning in early days around 2017, 18. And you have, I know, a very interesting story to tell, including around the just transition. And that's something that we've been talking with Nick and his team about. So I'm going to start with you, Shiv. Can you, I know you did contribute to the report, and so no doubt these findings will resonate with yourself. Could you tell us maybe a little bit more about how Ayana is, tell us a bit about Ayana, first of all, but also how you're seeing these climate risks starting to impact on you, your business, and your strategy to better respond to those.
Yeah, thanks for that, and thanks for having me on this discussion today. First, to give you a background about Ayana. Ayana was formed by earlier CDC and now BII way back in 2017. I joined the company in 2018, and the idea that BII had was to set up this platform to be able to develop renewable energy projects, both in solar and wind in the country, and especially focusing on the states which didn't attract so much of investment, and the states category A or category B, essentially the states in this country who were not on that list in terms of attractive destinations. So that was the target with which it was set up. And secondly, the other objective there we had was to ensure that wherever we work, we try to give back to the community in terms of whatever we could do. So the earlier stated objective was 100 million was invested, and we were supposed to achieve 300 megawatts in 3 years, and that was the objective. But good thing is that we were able to exceed the expectations of BII in the first 6 months itself by winning projects in category A states, and thereafter being able to attract additional investments. Total investments raised is about 720 million today. So that was actually a big thing in terms of getting the development capital in the first place, and then being able to attract growth capital from credible investors. So as we speak today, company has raised 720 million, and the portfolio is close to 5 gigawatt with 1.6 gigawatt operational capacity. And other important aspect which I think needs to be recognized is We are the only company in this part of the world and one of the top three in the world who have an ESG rating of A minus from ISS rating agency. So that is a huge testimony for this platform and a huge testimony the way BI has helped us to set up our systems, policies, and everything else to be able to maintain those governance standards and the principles around ESG with which this company runs. And we are on a solid foundation, I would say, around all these principles. And that's what helps us in terms of being able to drive the growth sustainably. So that's, a short overview of IANA. So with that background now, I'm open for your questions where I should start and what we should address, and we'll take it from there. I hope that's fine.
Thank you very much, Shiv. So maybe just one quick follow-up question, and I know we'll unpack this anyway as we go through the panel. But based on what you have seen in our report, but more specifically how you in India and IANA is experiencing climate-related risks, whether that's transition risk, which as a renewables company, I mean, you're part of the solution to managing transition risk, but also how maybe physical climate risk, climate impacts may be affecting your business and your strategy.
Yeah, I think climate risks have been, there. I mean, if you look at way back earlier, when you had, doing hydro projects, there were a lot of issues around the flooding and other risks associated with the water, and then also risks in terms of what that could actually cause later on once you have the hydropower plant built and all that. And we have seen some of those effects escalating over a period of time with the weather pattern changing, the rising temperatures, and everything else. But also at the same time, the way evaluation has been progressing, and let's say 30 years back, a project evaluation or a feasibility, the factors that would be considered, and the factors that we consider today from a climate risk perspective has completely changed in the sense that today you do all possible tests, both as far as physically or destructive testing that's possible to be done in terms of understanding the soil and other things, and then trying to do all possible desktop analysis with various software tools to be able to understand what are those one in lifetime issues that might occur, and are there any solutions to handle those lifetime kind of, even if it is 1 in 100 years, then are you able to manage those risks. Now, coming back to our particular business, we undertake all possible studies. For example, even if the wind speeds is going to occur once in 100 years, certain wind speeds level, what we do is we assess that and design the structures to be able to withstand those wind speeds, even though the occurrence probability is very low, but you design the plants for those factors. Now, second is, for example, in Rajasthan, the temperature during summer at times, once in 10, 15 years can get to about 50 degrees. So we design the plants with those. The probability of the plant operating at those temperature conditions is not on a day-to-day basis, but the plants are designed. Then at the same time, we will also look at the possibility of flooding of the plants, whether there is any possibility that floods can happen. And then accordingly, the drainage systems are designed right up front, incurring cost, assuming one day if a flood happens, then there is a way for the water not to flood the plant, but to be able to move it out to a safe side and get the drainage arrangements in place. So those are the kind of studies that we undertake and help in designing the plants. And also most important now is the weather monitoring and the weather forecasting has improved significantly. And now we have a lot of sensors that are getting placed all around all parts of the world. So you are able to see the historical patterns, how the weather has been, both in terms of rain or wind speeds or temperature or changes, everything else. And based on various modeling, then we are able to see what the next 30, 40 years is going to look like. So this, of course, continues to change, and accordingly, our analytical skills have completely changed in terms of how the plants are going to perform. So the kind of correction factors we applied in the past and the correction factors that we apply in terms of what asset can yield has undergone a change, and I'm sure it will keep undergoing a change. But coming down, finally, I think we have mapped all the possible potential risks, and each of those risks, we try to assess them, try to see how we can mitigate either through design or through the type of supply chain solution that we can bring about. For example, if we put a plant on a highly corrosive area near the sea, we go in for non-corrosive materials or coatings on those materials which can withstand the life for the next 35, 40 years. So those are the steps that we take. So with these aspects, I think it's a continuous process. So the good thing with us at IANA is that we are put in a place so that we systematically understand these risks, systematically assess them, and have a mitigation plan in terms of dealing with them and continuing to do our business.
Thank you. Yes, and so the very different types of risk that you're having to deal with and design in early on. So moving to you, Ben. So of course, agriculture is particularly vulnerable to the changing climate and climate impacts, and of course, smallholder farmers are probably really on the front line of the climate crisis. So, tell us a bit about Apollo Agriculture and how you're helping smallholder farmers in particular respond to the climate crisis.
Yeah, thank you so much, Amari, and thanks for having me here today to share the Apollo story and also the smallholder farmer story. It's very encouraging to see the reports aligning with our mission and also creating that greater awareness to the critical issues around climate change. For me, I actually say that this is very timely and also acknowledges and also reinforces the urgency of the efforts that we need to put in place so that we can be able to address the climate related challenges and how we can be able to support, especially as you say, on the climate, on the agricultural sector, which is usually greatly impacted by the impact of climate change. Apollo Agriculture started in Kenya in 2016. We expanded to Zambia late last year. And our mission is very simple, is to help smallholder farmers make more money. And we usually do this by providing the smallholder farmers everything they need to succeed as a bundle. So if you are a farmer, you are doing corn or maize, the way we call it here in Kenya, we give you everything you need to succeed. That is high quality seeds. We give you the fertilizer you need. We give you the training. We also add insurance as part of the package, just in case the farmer get a bad season, they're able to get compensation that goes towards forgiving their loan. But also, as most of you know, is that smallholder farmers still struggle to access credit or financing that can help them to be able to afford all those inputs when they are planting. But what we do is that we overlay financing on top so that these farmers can be able to afford the inputs and be able to pay slowly until they're able to harvest, sell their crop, make money, and pay back the loan. It has been working well, and we usually say that the solutions as to why smallholder farmers, not only in Kenya, but also in many African countries struggle, and the reason why they are still producing way less compared to their counterparts in the developed countries is because they are not able to access the inputs they need. And I think that is where we have really made a lot of investments around how do you build infrastructure that can help to get these known solutions to smallholder farmers in a way that they technology like machine learning, remote sensing, AI, mobile money, and mobile phones to be able to make it possible to serve these smallholder farmers who are very remote and distribution is even more challenging. But what we have seen with our automated approach, but also still making it very easy for the smallholder farmers that they can still use their featured phone, they can interact with us on SMS and USD, we are seeing great impact. So we have been able to be growing 2-3x every year. And we have been able to build a process all the way how we onboard customers, how we make lending decisions, how we do repayment and corrections, and also how we do last mile distribution in a way that we have been able to truly scale, but also be profitable while we serve these smallholder farmers. So far, we have been able to finance over 350,000 farmers. And the beauty of it is also that over 50% of these farmers are women. And the impact that we are getting is that once farmers start using our complete bundle, we are seeing these farmers doubling or either tripling their production in a season. And that is helping these farmers to be able to make more money. So that is about Apollo Agriculture, but happy to just state quickly around the impact of climate change that we are seeing and some of the ideas that are, or either some of the solutions we are trying to handle. As the report also quoted is that the impact on agriculture is very hard when you look at climate change. And one of the things you can see today, there is changes in temperature and also precipitation patterns. Amari, I can be able to tell you, like today in Kenya, by mid-March, that is when they have very heavy rains and is when our farmers are planting. But I can tell you, I'm looking outside and I'm seeing very hot sun. And that is why it can tell you like we are in it and it's hard. And when I was in the field last week, most farmers even are confused. Like in such an unpredictable environment, you find even farmers are not sure if the rains will come. They are not sure if at all they want to even do more investments or they want to take risk and even do half an acre if at all they were planning to invest in 1 acre. So that kind of an environment is very hard and is even having very significant impact on yield. Last season we did in Zambia, the farmers were supposed to harvest by June this year. But as you know, Zambia, they have been affected by a very bad drought, actually. And right now, if our farmers didn't have the insurance cover that we bundle in our package, I think those farmers will be going through a tough time. But I'm happy that with Apollo, because of the way we bundle, including climate insurance package, these farmers will be pursuing the insurance companies so that these farmers can be able to access compensation and possibly go towards offsetting their load. But I just wanted to give you those two critical examples that are happening just now, so that you can be able to see how hard the climate change is to the smallholder farmers. But also, as you know, with warmer temperatures that we are experiencing right now, the incidence of pests and diseases is really high. 5 years ago, farmers didn't use an armyworm solution that today costs over $13. Today, every farmer has to factor in additional cost for armyworms because they are even more intensive and the challenges even more. So when you look at water scarcity, when you look at input supply disruptions, like our agro-dealer business today, they are not sure if at all they want to stock the inputs for the season because they're not sure if the rains will come because of the change of the patterns. And if you look at insurance, it ends up becoming expensive because the insurance and the insurance market are looking at the season and seeing a lot of risk. And what happens? They end up like having higher insurance premium that end up to be very expensive for smallholder farmers. And some of these are just some examples of the impacts that we are doing. And the good thing with Apollo is that we are able to kind of come in to shield the farmers and build the resilience by bundling the insurance product, but also doing advisory in a way that we can be able to better inform our farmers in terms of when they need to plant, or either this type of seeds that they need to plant that are more adapted to drought-resistant varieties. So, and because some of these technologies are also very expensive for smallholder farmers to afford, we're able to provide the insurance so that these farmers can be able to afford those technologies.
Thank you, Ben. And yeah, really inspiring to hear everything you're doing and bringing lots of, services, as you say, advisory, being very much a, partner to these farmers, combining fintech, bringing, machine learning to help better understand the climate risks and integration of those into forward planning processes. So yeah, really, really interesting. Well, we're coming back to you and Shiv soon. I'm going to turn now to our panelists here in the room, but just as a reminder, because I think I forgot to say earlier, that if you're online, we will, if you have any questions, please put them in the Zoom chat, because we'll do a Q&A soon, and we'll obviously take questions from inside the room as well. So Michael, over to you now. Based on what you've heard, both from Nicola and the report, but also from our two investees, both of which bring very rich experience of dealing with the climate crisis and responding. Please tell us some of your thoughts.
Thank you, Emily, and thank you, Shiv and Ben, for those really interesting views from the ground, literally, in Ben's case. I was very struck in the report by the distinction I would make between the impacts that a business feels because people are talking more about climate change, including BII, who come along every year and ask them questions about it, possibly investors doing the same thing, maybe markets, maybe customers doing the same thing, and the actual physical changes that are occurring that are impacting on the businesses. It's still, I was interested that although the numbers have gone up in a single year by mostly 10%, most of those numbers have gone up by 10%, which in a single year is significant. The numbers on the impact on supply chains are still quite low. Now, that obviously partly depends on, that is partly because it's not absolutely clear what all these businesses do. If you're a business, a service-based business, you may not have very many physical supply chains. If you're a manufacturing business or an agricultural business, then your supply chains are physical, and we know globally are beginning to be affected by climate change. Certainly if you're in the food business, your supply chains are likely now to be affected, not necessarily every year, but somewhere in the world there is a disaster occurring which is affecting agricultural production. And I will be interested to see how those numbers change over time, because it seems to me that if climate change is now having physical impacts, and it's having physical impacts on production. And so that was quite interesting to me. The other thing that really struck me, from what you said, Ben, is on adaptation. Those of us who work at pretty high level, if we're honest, we're looking at this globally, it's very easy to have a picture in your mind of adaptation expenditure, which is an additional expenditure that you can clearly identify over a baseline of what you did last year or 5 years ago. And the kind of classic model of adaptation expenditure would be a seawall or a flood defence system, which you simply didn't need 5 or 10 years ago. And therefore the baseline was we didn't spend any money on that, and now we have to do adaptation expenditure, we have to spend on that. But of course what's actually going on for farmers is just a response to current conditions, and current conditions include climate change in the way that Ben has explained, but there is no baseline. There is no what would have this been like, what would we have had to have done this year that we now have to do because the climate is changing, or at least if it is, it's a pretty theoretical one. And the adaptation expenditure that's going on there is just expenditure, is just the normal business, what you have to do on your seed production, on your irrigation, on your and various other things. And it makes adaptation expenditure quite a difficult thing to actually get your head round. What exactly is the expenditure there? And I mean, I'm interested to you, Amelie and Nicola, what you count as adaptation expenditure, because to be perfectly honest, quite a lot of your investment in Apollo sounds to me like it's adaptive, whether it's additional or whatever. And so I think this is really important to get what this is looking like on the ground. And I was very struck by that. And obviously it's very different for different businesses in different sectors.
Yeah, maybe we come on to that. I mean, broadly speaking, we would look at, is our investment adapted? Is it resilient to climate? As some of the examples that Shiv gave, looking at, factoring in flooding, looking at temperature increase, etc. But then another example, or the other end of the spectrum, if you like, is what Ben is doing, where we would see Apollo Agriculture as a company that delivers adaptation services. They're both obviously extremely important. I think we've mostly focused on the former until now, and you talk about seawalls, etc. I think one of the interesting things, though, and particularly it's exemplified perhaps by our two investees, Shiv and Ben, is that some of these adaptation services may be quite small scale. So in terms of dollar invested, actually not that great compared to investing in a renewable energy project. But the impact in terms of number of people is extremely significant.
And it also it reveals the world is much more complex than the high level reports say. That adaptation, a lot of people are saying, well, mitigation you can make money out of, so the private sector engage in mitigation. I presume Apollo is a private sector firm, and it's making money, and its businesses are making money. That's what it is doing for them. And so this, adaptation isn't just an add-on that only public expenditure can do because it doesn't have any returns and so on. No, it is integrated into a business model.
Yeah, absolutely. So coming to you now, Nick, based on what you've heard, I know you're very familiar, you know Shiv well as well. Please tell us some of your thoughts around both the findings of the report, but also what you've heard from Shiv and Ben.
Thanks very much, Amelie. Great to listen to you, Shiv and Ben. I think the first thing that's really struck me is that climate change is not a sort of future issue, particularly on the impacts of climate change, the physical impacts, but also on the increasing relevance of the low carbon transition. I think this question is an immediate issue, and I think that's very clear. And both from IANA and Apollo, we've heard that as well. So I think that was very clear. I think what was really heartening listening to the two examples is that actually in emerging economies, you can have rapid growth of solution companies. So both IANA in terms of clean energy and in terms of agriculture, in terms of Apollo. And I think that's what we, particularly in countries like the UK, where we struggle to get beyond 0% growth, looking to these solutions, is we need rapid growth of solution companies, given the scale of the crisis. But then I think if you look at the findings of the survey, I think you see these sort of gaps emerging. You have those very big 97%, 98% saying climate is essential for business success. Yes, we need better investments. But I was struck, but only sort of 47% are actually incorporating climate into financial planning, which of course is the sort of the engine room of businesses. And actually that has gone down. So there seems to be a sort of maybe an implementation gap. And I think that speaks to the need for broader questions about structural financial reform, particularly this year. And it's probably something, Shiv and Ben, that you're not particularly involved in, but the climate negotiators this year have got to come up with a new climate finance deal, the very attractively known New Collective Quantified Goal, NCQG. And it's very relevant for these companies and the peer group and BII's portfolio, because the world has $500 trillion of assets. Only 3% of those are in emerging economies, and we need to mobilize more investment into companies such as Apollo and IANA. And at the moment, the transition mechanisms between those pools of capital in the global north and the investment opportunities in the global south are not working. So I think, again, so it's an immediate issue. Impressive examples, it can be done, but we've got some real structural issues, perhaps both within companies, but also in the broader financial system.
Yeah, very interesting points. We'll come back to you on that, and also how you're looking at just transition as well in that context. I think maybe we'll come back to you, Ben and Shiv. I mean, Nick posed an interesting point there. How do you balance climate-related objectives or risks in this context and your broader financial planning? Are there tensions? Are they competing? Or are you starting to see them coming together? Would just really welcome your insights on that point.
Maybe I can go first, but I fully agree with Nick. And what is that they are competing, because you see, like, the way you look at it is that today's smallholder, they need to feed the nation, and they are still in it. They are still in facing real impact of climate change. So as we invest in the long, you need to make sure that those small, you're able to invest in their resilience. Sorry, I lost video, but hopefully they can switch it on. But I will continue speaking. So I was saying, like, as you invest in their long-term kind of term investment to be able to manage climate change, for sure you need your ability. Because like today, just to give you a classic examples, is that smallholder farmers are still stuck to old technologies. If you look at a lot of gap that these farmers patterns have shifted. If they used to plant of climate change, and now they need to be able to adapt themselves, but they're still kind of planting the old seed technologies. There are definitely some research and investments that have been done in the space where they can be able to switch into better varieties, but they are still not aware of them. And the ones who are aware of them, they haven't been able to make the behavioral change, because for smallholder farmers, a season is everything for them. Is food on the table, is school fees for their kids. Those demo farms in their local communities, plant those new varieties, show them that they work in their local environment. That is when the farmer will be able to adopt to it. And in addition to that, as I said, some of these, even like the varieties I'm mentioning, they are a bit expensive even for farmers to afford. So it has to be a kind of an equation that of things that comes together, because even if you train that farmer and you showcase a better variety and you don't invest in terms of behavioral change, then, and also invest in terms of financing, making it easier for those customers to afford those new technologies, then you won't be able to achieve the final results at the end. And that is why I'm saying, like, it needs to be kind of a process where you are investing in the future. That is an area where Apollo is doing very well, because today we are integrating, even in the bundle, a package on advice start these farmers around. And the thing is that we are trying also to introduce climate smart inputs so that these farmers can be able to handle the impact of climate. But at the same time, we procure insurance at the end so that you can also be able to meet farmers really having the impact of the climate change, and they are not able to kind of adopt to it. And what we have seen is that once you provide that kind of extensive approach to still.
Okay, thank you, Ben. I think we're sort of losing a little bit.
Yeah.
But thank you. And I know there was a problem with the cable.
They require patience. They require,
which is probably making internet connection particularly challenging in Africa at the moment. I understand there was quite a big issue that last week. So I'm going to now turn to Shiv. Thank you very much, Ben. I think we really got a lot of that, but you are breaking up a bit. So I'm going to now turn over to Shiv to respond to the same question there. Are the, how you manage climate risks, opportunities, but with your financial planning and some of the tensions, but how are you approaching that, Shiv?
So, in terms of the risks, as I explained earlier on, the clear process by which you are able to identify all the risks with respect to climate change. Not only that, but at the same time, as a company, we do the studies covering all aspects of ESG. And that particular study and the risk analysis is not just restricted to the location where we are trying to set up the project, but that also covers aspects around the complete supply chain on which the project is going to be built. So that covers extensively in terms of all the aspects, not just what are existing today, because the assessment for this type of a business that we are in terms of generating power from renewable energy sources, we are looking at setting up the plants which can deliver over the next 30 to 35 years. So there's a lot of work that goes in around, and there's a lot of studies that go. There's a lot of development that is happening as we speak. And end of the day, what is also important to note, as we are in the business of generating power, the whole ecosystem of supply chain that goes to set up either a solar plant or a you know, wind turbines, both offshore and onshore, or pumped storage hydro projects, or battery storage projects. Each of these industry segments have a similar challenge as we have in terms of managing their own climate associated risks, and also in terms of their own action plans to be able to bring in value. Because end of the day, the cost at which any product or any service gets delivered has got to have a meaningful importance in terms of what's a sustainable tariff level for the growth to drive. I mean, so that is how it's going to work. So the associated supply chain, if you look, for example, I'll give you example with respect to the solar modules. So when, in this country, in India, when the first solar modules started getting installed, the per module wattage was less than 100 watts. And today, the next plant that we intend to build in the country is 690 watts. So what that effectively means is that efficiency has gone up tremendously. And earlier, the range in which the modules used to operate from a life, from a degradation perspective, from their ability to handle the temperature variations has again undergone a massive change. The type of metallurgy, the type of cell designs that have come up now, from P type we have moved to monoperc, and now we are moving to N type, and there is a new technology known as HJIT under now getting into commercial now. So you can see the huge transformation in terms of the technology. And similarly on the wind turbines, the oldest wind turbine in this country is at probably at what, less than 50 meters height, and small rotor diameter, and 250 kilowatts. Now we are talking about turbines, at least in this country, the machines available, single machine generating 5 megawatts. What this means is that the amount of footprint of land that you use is getting reduced tremendously, and the amount of generation that you can do out of that footprint is also increasing massively. And what that means is, to that extent, you are able to reduce the land usage and associated risks around that. And the process of the technology, the supply chain development is going hand in hand, and all work as partners, because end of the day there has to be a sustainable financial solution. So the technology development, the scale offers them to provide competitive solutions. In addition to this, the most important aspect for driving all this is financing. So today, I don't think financing for any region is restricted to a particular region. So there is a lot of financing, and also of late, what has happened is there's a lot of climate finance available. There's a lot of ESG finance available. So all this financing is also able to address these issues and give solutions, which helps in terms of trying to accelerate the energy transition, trying to support the complete supply chain, and generating companies like us with tailor-made products and competitive financing solutions which are long-term. they can go up to 25, 30 years and, be able to find solutions around currency hedging and everything else. So a combination of all these issues and given the risks on one side, so all in all these things have been going hand in hand, and that's how the acceleration in terms of energy transition is taking place. And that's why most of the governments are now looking at accelerating their transition process, and a lot of them have set their net zero targets, including India at 2070. And now each of the industrial companies are also setting up their targets to be able to get to net zero. And obviously, all these targets will encompass handling the climate related risks and issues.
Great, thanks, Shiv. Really interesting to hear how quickly actually the business sector is starting to move forward with these net zero transition frameworks and other similar initiatives. So maybe I'll come to you, Nick, on some of the points that Shiv made. I think quite relevant to how you've been looking at some of these issues. And I mean, what do you think is more investors could do more to really help ensure that these businesses can move faster but more effectively at an affordable rate?
Again, I think listening to Ben and Shiv, really interesting. Again, maybe stepping back, sort of why are we doing all this focus on climate finance is actually before the impacts on people, particularly in developing countries. And I think that's where this theme of the just transition, which is coming through, it's not a sort of an extra new idea. It's about, as Ben was saying, how do you ensure that you're getting finance to the smallholder finance? How are you empowering women, and particularly in financial terms, in terms of access to finance? The point about technology, which Shiv was talking about, in terms of improving efficiency of wind turbines, means that potential land conflicts go down because you're being more efficient. One of the things, I mean, investors have been talking about climate change, certainly in the Western world, for 20 years. So this is not a new issue. We have big architecture around this internationally. One of the challenges, though, and it's from meetings we've been having, is I think particularly entrepreneurs and investors in emerging economies see this as a little bit like ESG rain that's coming from the global north, and it's raining down in terms of new conditionalities and new requirements, which can be not always adapted to the circumstances of those countries and companies. So therefore, it's really important, I think, for investors, particularly public investors, such as BII, or in India, the National Infrastructure Investment Fund, to actually work with companies so that these requirements which are needed are very appropriate for the conditions, and then again work with the sort of local financial system to again make sure that ESG and climate requirements are embodied into those systems. And India, which I know better, I mean, India has actually a pretty good corporate reporting system. The business responsibility and sustainability report is actually better than anything in the UK, much better reporting requirements, particularly on social issues. And so that's a homegrown model, which I think is particularly useful for how Indian companies, private or otherwise, can both measure but also be accountable for. So I think really thinking about that local dimension, and then the role of central banks, financial inclusion, as Ben was talking about, central banks' role there, but also increasingly, I would say, monetary policy. Because if we're seeing these climate shocks, which we're seeing particularly in agriculture, leading to upward increases in inflation, then we have a risk of potentially that's going to lead to higher interest rates, raising the cost of capital in countries which already have very high cost of capital, make it even harder for people to make the investments they need. So I think it is a system solution, but I think making sure that we sort of avoid ESG rain from the global north and make these sort of climate and sustainability requirements very adapted to local conditions.
Yeah, you've covered a lot of issues there, and I know, Michael, you've been looking at a lot of those issues, particularly the issue around debt sustainability. What does that mean for sustainable development? You've been working with Bridgetown, the Bridgetown agenda. So can you maybe just give us a few of your reflections on some of those points that Nick just highlighted. And after your intervention, we'll open up to Q&A. So anyone in the room, if you do want to ask a question, I think raise your hand so you can receive the mic. And online, please put them in the Zoom chat. So Michael.
What strikes me about this conversation is we are sitting in London. We are being co-hosted by BII. So naturally, the focus is on international finance and international public finance, and those are not the most important sources of finance for most businesses in developing countries. The most important sources of finance for most businesses in developing countries will be domestic, and even the public finance will be domestic public finance. There are over 500 public development banks in the world, and as there are only 200 countries, that's an average of 2.5 public development banks per country. There is a lot of money that isn't either international finance, public finance, or international private finance. And the international private finance tends to flow to a rather small number of countries that have market access, that are would even be considered by most credit committees, investment committees in a Western pension fund or an insurance fund, and non-concessional lending, even by MDBs, goes to some countries and not others. So I'm interested in the wider ecosystem. In a way, the question I want to ask Ben and Shiv is, yes, you get a bit of money from BII, but where does the rest of it come from? Is that from domestic capital markets, and is that mobilised just in the domestic private capital markets? Are you engaged with any public development banks that are national? And how does that ecosystem work? One of the things that's going on in the MDB, the Multilateral Development Bank reform agenda, which is quite a big agenda, is the idea of country platforms, in which it is hoped that different financial institutions will meet together at a common place to look at the investment needs of a country or a sector. Interested to know whether that seems to be happening for you, whether you can see coordination between the different financial institutions, because I think these are the questions on the ground that really matter. And again, speaking in London, high-level events, some of this is very, very high level. And even the MDB reform agenda, MDBs do debt, they don't do equity, whereas BII does do equity, and you need some equity investment. The multilateral development banks do some countries, but there are other countries that don't get access to that non-concessional finance, and access to concessional finance is very difficult for many countries. Again, interested to know whether the businesses that are represented here have had any access to the concessional finance that we talk about at global level.
Great. And so, Michael's now posing questions to the panel. And I know, Shiv, it would be great maybe when you respond, if you could mention how the National India Infrastructure Fund has been effectively mobilised by, we were the initial, obviously, equity investor to establish the platform. Maybe you could say a few words about how you see that mobilisation of domestic capital that happened at the second round in 2021, I believe. Because obviously you talked about the target being 300 megawatts of renewables, and now you're 5 gigawatts. So really, quite a phenomenal growth. And Ben, maybe we'll come back to you as well. But before coming back to both of you and panelists in the room, I just want to check if you have a question in the room. There's gentleman here and a lady here. So we have two people with mics, and then there. So maybe the mic here, and then the lady here. So we'll take these three questions, and then we'll have a round of response, and then we'll see if there's any questions online.
Hi, my name is Sagar. My interest is in supply chains. Two factors I've noticed that rarely ever get discussed while talking about going green is where are all these resources coming from? I've spoken to people in India and Africa. I know about the issues like many other people do about Congo. And in terms of human rights and resources, what's happened over the last 6 months in Gaza pales into comparison to nothing, as bad as it is when you've got millions of people enslaved and killed going into the mines to get the resources for going green. And that's never, ever given any attention. And then the money, we bailed them out in 2008, Lehman Brothers. We bailed them out last year. We're going to bail them out this year again. $34 trillion in debt is the US. Where's all this money coming from? You can't print more zeros and ones on a screen. So all these efforts to go green, I'm struggling to understand where is the World Economic Forum getting all these resources, which is about ripping off Africa, which is why France has been kicked out of certain countries in Western Africa. That doesn't seem to get any attention. And is it really the case that the Global South gives us the resources, but the narrative is always controlled by the Global North? Thank you.
Okay, so yeah, a lot of important points, because I think a lot of the critical rare minerals, metals, and are in many parts of Africa. So panelists can come back to that as part of the response to these three questions. So please, and sorry, introduce yourself as well.
Rick Dahan, I'm Director of Development and Public Finance here at ODI. My question is on the very interesting survey and study, is that whereas the risk perception and reporting had clearly increased, the investment, both operationally on investment, seemed to have decreased compared to 2022. And I wonder whether either it's a bit of an effect that is seen on the backlash on ESG that we are witnessing, or whether it's simply that the cost of climate has been almost absorbed, business as usual, and therefore is not necessarily put forward as an additional cost, investment, operational, supply chain. I'd be very interested in your thinking.
Yeah, that's an important point. And I think actually some of Shiv's comments around how the technology's sort of evolving, there's some of these adaptation are starting to happen anyway, so quite interesting. So and then one more question here before asking the panels to respond.
So my question was that in the report you shared that businesses are looking at lowering their emissions. That's one of the directions which is, is overwhelmingly taken by the businesses. So when you talk about, lowering the emissions, is it only in their operations, or is it, because when I look at the reports which, companies are publishing, they have very, pointed targets when they look at their scope 1 and, a bit of scope 2, but scope 3 is, just put at, the national target. So, I mean, are we looking at all of this with blinkers, to add to what he said, so are, maybe when the scope 3, emissions start getting, recorded and start, coming out, we may realize that, this was all being looked, not in the right direction, So I just wanted to understand that, why is scope 3, not taking center stage? Why are we not looking at the entire life cycle analysis of a product, or, what's going out, whether, how it gets used at the consumer level, how much of it is wasted, its emissions at its end of the life cycle? Because I think that is really missing, in just going to, reducing operation emissions.
Absolutely. And I think, definitely that was one of the key findings, that it is that businesses are finding scope 3 particularly challenging to understand. It's, just being able to assess those. And that is an area that we're seeing more demand for support around that. So, and we've been joined by Nicola for the panel. So I may start with you, Shiv, Ben, and then work back Nicola, Michael, Nick. Please, there was quite some questions specifically posed to you, but please respond to any of the points that you would like to.
What would you like me to cover now? So just,
So, well, Michael, who's trying to do my job here, is asking, how have you been able to raise capital? I know the story around NIIF is quite an interesting one. Maybe you could say a few words about that.
Yeah, so as I said, we started with 100 million from BII. Then we had this National Infrastructure Investment Fund, which is a fund in which Government of India holds 49%, and the rest of them again are mostly sovereign funds from around the world participating. It's close to a billion. They're raising another 2 billion now, essentially focused at investing into the infrastructure, projects in the company, and most of that investment is going as equity investments. But apart from us, as you see, India today ranks probably in the top three in terms of as an attractive destination for the renewable energy, investments in the country. And the advantage that is the country offers is all the bids are in a transparent and competitively bid manner, and policy regulations are there. Though of course there are some challenges, but government is actively involved in terms of resolving and driving the growth. And we have right from pension funds to private equity players to sovereign funds to you name the funds. I think they're all participating in some way or the other, and a lot of them are as anchor investors holding majority in a lot of leading companies. So both bilateral, multilateral. So everyone is there investing because the amount of opportunity the country offers is huge. We are talking about getting to 500 gigawatt by 2030. I don't think there's any other market in the world which can offer a growth of 30 to 50 gigawatts in a year. So that's the kind of attraction here. So obviously, all type of equity investors and debt investors both are actively involved in the country, and there's a lot of capital available. We've not seen any issue per se with respect to availability of capital in the country today, both on equity and on debt.
Thank you. And but of course that wasn't the case in 2019 when we first worked to establish ANA. But it's I think extremely encouraging to see how fast the renewables industry, renewable sector is growing in India. And obviously, Ayana, you have a lot of reason to take credit for that as well. So I think, Ben, if you could respond to some of those questions, whichever you feel. I think there was one in particular around why, maybe this slightly counterintuitive point that businesses may not be changing their operations as a result of climate change, that may have gone down. The question is that because it's almost becoming business as usual? And I think some of what you said, to me, implies that it is already a sort of business as usual in some respects. But feel free to respond to any of the questions you heard.
For sure, including the resourcing part. But I would say, like, for us, it's not really business as usual. It's really like we are in it and we are facing this risk head on, and we have to be very innovative and thoughtful. We are already trying to integrate, as I said, these climate smart solutions that really helps our smallholder farmers to be able to tackle the issue. As you know, like 98% of the smallholder farmers in Kenya depend on rain-fed agriculture. If you look at the wider Africa countries, they're still at around the same high 90s in terms of farmers depending on rain-fed agriculture. That just tells you how that is a big challenge in terms of like having the warm temperature, very different rainfall patterns will still kind of impact our farmers a lot. And that is why I say today, we are doing a lot of capacity building with our customers, ensuring that we are able to train them, we are able to show them that for sure they can be able to start adopting by better tools and better technologies and bringing financing so that these farmers can be able to afford it. The other thing I would like to say is that for sure there is inadequate funding for innovation and scaling the proven models so that they can be replicated in many regions. And what I can say that where the money is coming or the resources are coming is still from the global impact investors. And as the same as we know in agriculture, even for the SMEs, it's still often challenging to secure loans even from banks, and the same case even for our farmers, but also same case even for businesses from investors, because there is always this perceived high risk, especially with climate change, in terms of like the risk that is embedded in the agricultural business and even the seasonality nature of our businesses, right? So you find like they're not very appealing to many investors. And that make it even challenging for some of these innovations to be able to raise the resources that they need to be able to scale. As I said, some of these resources also needs to have some patient capital, because with the recent climate change, it requires a lot of work so that you can be able to kind of make some headway in terms of supporting the smallholder farmers. I'm so excited to be able to see BII being part of the team that support us in terms of early journey, in terms of what we are doing, and we are making great impact, and looking to see more investors coming on board to be able to support us in terms of getting these solutions, climate solutions to our farmers. But the other thing finally to just mention is that this journey has to be a kind of a PPP model where there is more partners coming together to be able to solve even the resources gap. Because as I said, there's still some gap in terms of innovation and scaling. And we have been able to see at least some good combination of capital from public and private sector. As I said, it's still very low on local sources, but recently at least we have been able to see very good support, like we crossed a $10 million from Sweat Fund, which is more like a public-private partnership that will be able to provide us with the capital that we can be able to finance our customers. But also late last year, we were able to partner with AFDB, who were able to provide us a risk guarantee that enables us to continue funding these smallholder farmers. And I think that to me is really like the blended financing models are very powerful, because you see, like once we get those kind of guarantees, we are able to at least secure working capital and debts from investors that makes them more comfortable to be able to lend to us in a way that we can also lend to the smallholder farmers. So we want to appreciate those supports, but also looking forward for more of similar support that we can be able to continue making impact. And overall, just final comment for me is to say that climate change is real and is really affecting us today. And I really like BII with the support that they are doing, and also the report, and also say what everyone is saying, like we need to act now because we are in it and we need to make some progress.
Thank you, absolutely. So moving on, so I'm conscious of time now. So Nicola, maybe you could respond to this issue of Scope 3 emissions.
Yes, no, thank you for that question, because I think Scope 3 is always an issue, I think, that comes up. So I think you will also see this, I think, in our report in more detail. So in our report, we outlined that more companies and more financial institutions are actually footprinting basically their operations and emissions. But what you will also see is exactly what you said, that most of them are focusing on Scope 1 and 2, and there's more to do on Scope 3. So I think maybe a couple of points on that. One, I think it's quite important to distinguish between corporates and financial institutions when we talk about Scope 3, because they require different tools and they require different sort of advice in terms of how to integrate this into their business. So when we talk about corporates, obviously it's the sort of value chain, where you're getting your material from, what is your product basically used for in the end, and that obviously requires quite a lot of data in terms of really analyzing that that. But it also requires to talk with them, what's really, I guess, the business case around understanding of scope 3. I mean, there are some countries where we see increasing regulatory requirements around this, but in the end it comes down to why do you need this data in terms of integrating this into your business. So if you think about upstream scope 3, it could be, your material use, really thinking about the long-term strategy there in terms of the costs associated with it. And similarly, I guess on the downstream side as well, introducing sort of more circular models in your business, again, which can hopefully over the long term also help with your sort of cost structure. But when we talk about financial institutions, in the end, their scope 3 emissions are their investments. And again, I think that's where in the last couple of years, I think, seen some more progress, because I think in the past, particularly financial institutions, they mainly talked about their operations, so their energy use, their office energy use, their travel. But in the end, where we as investors have most of our investments is in our supply chain, which are our investments, and therefore that becomes increasingly important.
Okay, great. Michael, maybe do you want to respond, or maybe also to this gentleman's question?
Reporting is important, but it doesn't in itself change anything. And we've used reporting as a mechanism to say we're doing something about this in quite a lot of areas. Gender pay gap is another one, where it's a very weak instrument, reporting in itself. You hope that it will lead to action, but scope 3 reporting needs to be, the reason it's important is when there is actually an impact that occurs. I want to take on the question of critical minerals, and let's, I want to in fact broaden it, because we're sitting here looking at hopeful signs in the international economy. Companies that are impacting on to mitigate climate change, to adapt to it, institutions which are investing in it. The ODI done a lot of work around national development banks. Sam's done that, Bianca, Frederic, and who are here on multilateral development banks. There is hope, there is stuff going on, but if you want the gross picture, money is flowing out of the developing world right now. More money is leaving the developing world and going back to the north. Both because investment has been withdrawn as interest rates have risen in the US and the North. Money has flown out, as FDI always does, follows the interest rates, and because debt repayments are now exceeding new lending. So the big picture is negative. Now, that's one of the reasons why there's all this activity. We kind of acknowledge that. But around the debt field, almost nothing is happening. So Ben's company said he was working in Zambia. Zambia is still in the middle of a debt restructuring under the common framework. It's been going on a long time, partially resolved, not fully resolved. There are 25% of middle-income countries, more than that of low-income countries, which are in debt distress or at risk of it, according to the IMF. A lot of repayments are due in the next 2 years, so this debt crisis is... so that's the bigger picture. Yes, there's a lot of good stuff going on, but it is unfortunately not bigger than the smaller stuff. And the wider picture, as was said here, is of still very exploitative practices going on in developing world, particularly in the mining sector, which has long been the worst performing sector on human rights, on environment, and so on. And it has now, as you quite rightly say, kind of come to the attention of the environmental movement, because we are now dependent on many of these critical minerals. And instead of being something that was going on somewhere else, it's now very much in our frame. And that's an issue that is not easily resolved in the short term, because mining is a private sector industry with its own military, with its own security, with in many cases appalling practices, and our dependence on it is such that not nearly enough attention has gone to it. And I do think this is the next area. If the investors, the international community has started asking about emissions, we're going to start asking about human rights and environmental impacts in the mining sectors. There's a bit of that, I think, emerging, but as you quite rightly say, not nearly enough. And it does affect the relations between North and South governments. I'm very struck that the G7 over the last couple of years has decided that critical minerals are very important and it needs to think about its supply chains. That's arising partly because we need more of them and partly because China does almost all of the refining. If you look at critical minerals around the world, they're distributed everywhere, but China does 90% of the refining mining, because we all want now in the West to be less dependent on China. We're suddenly concerned about this. But if you look at the supply chains, they're all private. Actually, governments have very little impact over those. So this is, I think it's really important that you've raised that, and I think it's something that we are going to have to address much more seriously.
Yeah, and I think, as development finance institutions, we obviously are very concerned about human rights in the supply chain. And actually, we are not investing in the mining sector because, frankly, it requires quite a deep skill set. The World Bank has a very big program around sustainable mining, but I think most development banks and DFIs are not. And it is, I think often, as Michael said, it's sort of private sector may now own the rights to a lot of these. So I'm coming to you, Nick, and I'm just looking to be about another 5 minutes, but were there any questions online that you wanted? Okay, so Nick, if you go, and then Sarah, if you could just to obviously be able to respond to those.
Really good. So, I think we are in a situation where we need to transform our financial system. Many of the reasons that Michael suggested, that actually we have this flow of capital out of the emerging economies and not into. But I'd also like maybe to highlight that there is emerging market leadership, particularly the G20 with Indonesia last year, India, this year Brazil, next year South Africa. President Ruto of Kenya has also been very strong about how the financial system needs to change. So I think that's important. On this theme of supply chains, we've had last week the EU's Corporate Sustainability Due Diligence Directive stripped down, but it is progress, and we have the long-standing requirements really of soft law through the OECD multinational enterprise guidelines on responsible business. And these types of tools are not purely reporting. They actually are about performance and outcomes and so on. And I think that's where it comes back again to this issue of just transition, which is what this means for people on the ground. One of the next things we're going to be doing is a case study actually of Ayana, of Shiv's company, to look at how you can roll out renewables with a conscious workforce for women and communities. And our next report actually is going to be on mining, both how do you phase out fossil fuels in a way that respects workers and communities, and how you phase up the critical minerals that are going to be needed. And one aspect of that is to take a proper focus on demand reduction and circularity, but then really be thinking about human rights and environment as part of that, particularly in forest communities, which where a lot of these critical minerals are sited.
Yeah, thank you. So Sarah.
Touched on it slightly there. So the question was for Shiv. Interested to understand more about how Ayana sees the people-related risks of the just transition and how to manage these. How to ensure that the necessary transition away from coal-powered energy generates good quality, decent work opportunities. And then there's another question just interested in the Caribbean specifically, talking about how the Caribbean is has one of the highest risks to climate change, an area that has the highest energy costs and transition risks are high. Just interested in the opportunities that are seen from a climate perspective in the Caribbean.
Mm-hmm. Okay, great. So Shiv, do you want to respond specifically to this issue of just transition in India, which I think Nick just sort of touched on as well?
Yeah, sure. I think as far as India is concerned, I think there's a lot happening in terms of just transition or energy transition that we know. Apart from the renewable space that we are looking at, initially it was just trying to do projects standalone, wind or solar. Now the market has moved either going through a hybrid, which is combination of solar and wind, or mostly it is round the clock clean energy, because that is what is the need, because it doesn't really help. And to that effect, in terms of storage technologies, I think India is now looking at a lot of investments coming on the pump hydro storage projects. And secondly, in terms of the battery manufacturing capacity coming up, the interesting thing to note is in the recent bids, which is known as fixed dispatchable energy projects, which were bid out, the tariffs discovered have been quite competitive. and also round-the-clock tenders, the tariffs have been quite competitive. In fact, it is coming at a level of fossil fuel tariff now. So once you have competitive solutions, then it's something that can quickly accelerate the process of this just transition. This I'm talking from a perspective of energy that's required. In addition to that, country has accelerated on the EV technology, and there's a clear policy in terms of driving the electric vehicle growth. There has been, production-linked incentive that the government gives, where people are going to set up battery and cell manufacturing to support the electric vehicle industry, meeting certain norms and certain capacities. Now, the third aspect which the country is trying to drive is around the green hydrogen. So there is a clear policy that has come about in terms of setting up electrolyzers. There have been bids now which have just come out. So in a couple of years, we expect the cost of green hydrogen to get down to a level where it could replace a lot of other alternative fuels as a fuel in terms of fuel cells for automobile or other industries. The third area which is really going to make a difference, and India is going to probably become a hub, is around exporting green ammonia. So there's a policy, and there's a lot of discussions happening around companies trying to set up ammonia production facilities around the coastal lines of this country, so that it becomes much easier to produce and be able to export it to various countries. We have now quite a few agreements that have been executed, and also government of India is looking at agreements with other governments to have a G2G agreement covering the areas of green hydrogen and green ammonia. So as you can see from the aspects that I mentioned, there are a lot of areas that are happening in terms of driving the just transition, and I think a lot of ambitious targets have been set. And in addition to this, there is a focus on getting the manufacturing play in place, and also to drive this in a way that supports all the aspects around ESG governance and everything. There is an increased awareness around ESG now. Government has tightened a lot of I would say standards, policies, approvals covering these aspects. So we would see that a lot of this growth and everything else that is going to happen is in a very, very I would say transparent way, and in a way where policy regulations is aimed at protecting the climate and driving the growth, looking at all the risks that we spoke earlier about. So all in all, exciting times, I would say.
Shiv, and actually I did, so my final question to the panel, but I think you've responded already well, is what makes you feel optimistic about this agenda? Now, obviously, there's a lot of challenges that we've heard about in great detail, but some reasons to be cautiously optimistic. So thank you very much for that, Shiv. So maybe turn to you next, Ben, and then we'll come to the panel here in the room. And I'll maybe respond briefly on the Caribbean question as well. But Ben, what makes you feel optimistic about some of what we've been discussing?
I think what makes me excited is that the conversations are already happening, right? I'm so excited with the work the BII have done on the report, and also already you're already doing it. You mentioned 30% of the investment that you are making on targeted approach to climate smart. So that give me like a lot of encouragement that is not only a talk, but we already in it implementing. So we have a long way to go, but for me, I think is very exciting to see the discussions happening, the research happening to understand the scope and also the areas where we need to prioritize, and also the already solutions on the ground that are already in it and trying to support. For me is what I say that in a situation where you already have the challenge, you have to balance the long term and also the short term. So as we balance the long-term impact of climate change, we need to remember that there are people already being impacted negatively and in a hard way that needs to be able to be supported from a resilience point of view. And I gave the example of the farmers. Much as we can be able to support them to adopt to better climate smart agricultural practices, today they are going to their farms and planting with the hope of feeding their families, but they end up with a very bad drought, like is what is happening in Zambia. And at that point, we have to really make sure that we are building the resilience to make sure that those farmers are not dropping below the poverty line. So it's kind of that kind of tricky balance. But for me, I think I'm very excited, and thanks so much for the conversations that we had, and thanks to the panelists.
Thank you. Thank you very much, Ben, and Shiv, thank you. So maybe Nicola, we'll go back this way.
Thanks, Amalie. I think, as you said, I mean, there's lots to do. I think we discussed many things today. I mean, supply chain, global financial system, macroeconomic conditions. So it's quite complex. But I think what excites me is actually, I think, the entrepreneurship that we are seeing in our markets to actually come forward with these sorts of climate solutions. Obviously, we have Shiv and Ben here, who are two great examples of entrepreneurs who are actually addressing these challenges. But I think over the last couple of years in BII, I think that's where we really saw more and more opportunities. So it's either entrepreneurs who really get, that they need to adjust, that they need to implement these measures, or actually taking advantage of the sort of business opportunity to offer these solutions. And yeah, I think there's lots of great ideas out there, lots of great entrepreneurs. So from an investment perspective, I think it's a really exciting time. Obviously, it needs to accelerate much more going forward.
Michael.
I'm excited by these two examples, and it's great to have a panel that's mainly overseas. The world is not in a great place, you might have noticed, but the pressure now to increase and improve, not just increase, development and climate finance that is in the international system. You mentioned the Bridgetown Initiative. Mia Motley from Barbados. President Macron organised their summit last year. The Indian G20 presidency has taken it forward. Brazil is currently doing so with a focus on hunger as well as climate change. We've just started working with the South African government. They are preparing for their G20 presidency. There is pressure building, and interestingly, the leadership for this is coming from the Global South, which is in itself interesting and important. And although the northern powers are fiscally, they perceive themselves to be very constrained. Nevertheless, pressure is building. There is pressure for recapitalization of the multilateral development banks to squeeze more money out of the existing balance sheets and so on. And that is a source of hope at an otherwise very difficult time in international relations. And I do think that over the next 2 to 3 years, we will see more money going into development and climate finance. It'll be much more integrated. Climate finance is a kind of barely a proper concept anymore because it's so integrated with the rest of development finance. And in the MDBs and in the national development banks, you're seeing very innovative new financing mechanisms, new energy and initiative. The IDB, Inter-American Development Bank, just launched something very interesting in the last few, your old employers, Amalie. So there is a lot of activity out there, and we've got to hope that it yields some money and some stuff on the ground as soon as possible.
So again, very inspired by the leadership, and I think also the recognition now that sort of climate is not just a sort of technocratic thing that is a burden for people, but we need to think about this as a very inclusive process, the question of fairness and the question of just transition. That's now taken for granted. I think the next few years are obviously crucial. We do have a timeline. We need to deliver. And that means the shape of the investment curve has to be sort of exponential. And we've seen, I think, Shiv talking about that in India for renewables, but we need to have that same sort of increase in deployment and impact for people across all sectors. And so that's the real challenge.
Yeah. Okay, so I will, I mean, maybe I'll just give what helps me feel optimistic, but also respond briefly to the point on the Caribbean, which I think the Caribbean is clearly in a very vulnerable area with the hurricanes that have become, much more intense, and the frequency of intense hurricanes. So is obviously, in a very vulnerable position. But I think, like many sort of as a small islands, that also brings specific challenges. And I think similar to as we see in other smaller countries, particularly in Africa, how to really help unlock this entrepreneurship that Nicola referred to, that we see with both Shiv and Ben. How do we do that in a way that can benefit smaller countries as well and more fragmented markets? And I think a lot of the solutions that we're hearing about, particularly as Apollo Agriculture demonstrate, that technology is changing. We have a lot now in the form of fintech, smarter systems, whether that's for energy, for water, etc. So the key now is how to really accelerate the transfer of those and investment of those in all countries, but including those much smaller markets, which are harder to get the scale that is fortunately now we're seeing happening in India. For smaller markets, that's much more challenging. But yeah, so I feel optimistic about technology. I feel we have a lot of those solutions. We just need to remove barriers to really scale investment in those. So I think now we have gone slightly over time, not too much, but thank you very much, everyone here. In ODI, we had an interesting piece of scaffolding being assembled during most of this event, but it seems to have been disassembled as well. But thank you also to everyone online, and particular thanks to our panelists here in London, but also in India, Shiv in India, and Ben in Kenya. Thank you very much.